There we go. Jesus. Episode 3. Let me just get some lo-fi hip-hop. Tons of people watching. Testing. Testing. All right. I think we're good. Okay. So. We've got all right. So, new stream notes, I guess. It's been a while. 5:24. I apologize. This isn't the most recent one. So, wait, let me do something real quick.
Mic feedback off. Mic feedback on.
Testing. Okay. It's weird. Okay, so today is 5/24/23. It's like 2 weeks later. Because I didn't do it on the weekend. I should have, and I was busy this weekend, but alright, let's think about this. So, I think a good strategy for today would be to just bang out all of these tabs that I still have. And then, yeah, we could wrap it up. So, summary from last time. Fixed income instrument is an investment that provides a return through fixed periodic interest payments and eventual return of principal at maturity. Securities are fungible, negotiable financial instruments that hold some type of monetary value, like stocks, bonds, or investment contracts. Options. Oh, I should leave. Hold on. Sorry about that. Options are contracts giving the owner the right but not the obligation to buy a specified amount of an underlying security at a specified price within a specified time. Gotcha, so it's an option. Equity represents the shareholder's stake in the company. Okay, equity, my stake in the company, my equity, gotcha. Bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. Gotcha. Reconstitution is the revaluation of a market index. The process involves sorting, adding, and removing stocks to ensure that the index reflects up-to-date market capitalization and style. Gotcha. Outstanding shares refer to company stock currently held by old shareholders. Outstanding. Market capitalization, also known as market cap, refers to the total dollar market value of a company's outstanding shares of stock. Okay. Of a company's outstanding shares of a stock. Gotcha. Liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. Gotcha. Yep. So indexing is a form of passive fund management. The idea is that by mimicking the profile of the index, the stock market as a whole, or a broad segment of it, the fund will match its performance as well. Their strategy instead seeks to match the overall risk and return of the market on the theory that the market always wins. A tracker fund is a broader term than index fund that encompasses various investment vehicles designed to track an index. While index funds are one type of tracker fund, the term tracker fund can also include other instruments such as exchange trade notes or even separate accounts managed by institutional investors. A tracker fund accumulation unit is the best unit for long-term growth. An investor in index funds must remember that index managers need to buy the additions and sell the exclusions according to the reconstitution, nothing else. They do not make these changes based on performance of the stock, but rather to match the reconstituted index the fund tracks. Gotcha. Market liquidity refers to the extent to which a market, such as a country's stock market or real estate, allows assets to be bought and sold at stable, transparent prices. Illiquid stocks have wider bid-ask spreads and less market depth. These names tend to be lesser known, have lower trading volume, and often have lower market value and volatility. Thus, the stock for a large multinational bank will tend to be more liquid than that of a small regional bank. Yup. True. I get that. But after reconstitution, index managers no longer feel these liquidity demands. Newly added indices getting pumped, deleted indices getting dumped. And so the price effect generally goes into a reversal with an index's additions underperforming and deletions outperforming. This can negatively impact performance of all funds tracking these indices. Gotcha. Okay, we're at a good basis. I think we're in a good position to just knock all these bad boys down. What just? I just lost everything. Oh man, this isn't worth. Oh man, give me. Oh man. You're not smart enough to. Interesting. I kind of don't like this. It's for like, I guess when like you have like charts or whatever, but I'm not gonna do it. This we can close. All right, let's tackle these. Let me make sure. I want to look at my old one just to see what kind of. Okay. So I I closed reconstitution. So we were done with that. I closed understanding liquidity. I did not close market capitalization. Close the outstanding shares. Jeez, man, I don't even know what are index funds. I definitely have a what are open. Do I have tracking error? I have tracker. Dude, I don't have any of my things open from last time. Do I have benchmark open? Don't have benchmark open. I understood this, yeah. The NASDAQ 100 and S&P are two of the most popular equity indexes in the United States. The NASDAQ heavily allocated towards top performing industries, which have helped the NASDAQ 100 outperform the S&P 500 between December 31st, 2007 and March 31st, 2020. Below is a comparison of annual total returns, which reinvest dividends. Okay. Well, that's a little scary. So, NASDAQ took a deeper dive in '08, but it took a smaller dive than S&P. The table on the right and the charts above display historical performance figures for both the NASDAQ 100 and the S&P 500. Despite recent overall market volatility, the NASDAQ 100 has maintained cumulative total returns of approximately 2.5 times that of S&P. Well, that's okay, this is interesting. We can see important differences between the NASDAQ 100 and the S&P 500. As mentioned previously, the largest allocations to both technology and consumer services helped propel the NASDAQ 100 to a new all-time high on February 19, 2020, while also driving continued outperformance throughout the duration of first quarter 2020. The NASDAQ 100 finished the quarter with a loss of 10.3%, nearly 50% smaller than the S&P 500 loss of 19%. This most recent outperformance mirrors what occurred in the last major market turndown in the 4Q18. For 2018 as a whole, the NASDAQ 100 outperformed the S&P by more than 4% and maintained its streak of positive annual returns. So we can see financials is heavily biased for S&P 500. It's not even covered by the NASDAQ. The NASDAQ is so biased towards technology, which is a little scary, but also I wonder right now what it would be. So like if we do like a 1 year, it's up 13.9%. Do a 1 year. Huh. is up 3%. Nasdaq's up 13. 2%. 15%. I mean, that just looks better. Haha. I don't know what to say. Everyone talks about the S&P 500 though. I mean, just looking at them. Oh my god. I have like... Is there like a... compare? It's like it gets bigger, but it also got lower lows. Wait, max. Oh yeah, dude. I mean, look at that. That is just pure. Just beating it out. But I guess if we're talking about like as a whole, it's traditionally been safer. Like, look at that, dude. Look at how close they are to each other. I don't know if that's like perspective. It might be a perspective thing, because if you look at it, it's 1200, 200. This is hard to gauge because the peak here is like messing everything up, but I guess it's a legitimate thing to think about. So conclusion, the NASDAQ 100 and S&P 500 are two of the most popular equity indexes in the US. We provided performance and volatility analysis for almost 12 years. The NASDAQ 100 is heavily allocated towards top performing industries such as technology, consumer services, healthcare. The growth of companies in these industries have continued to be strong given the way technology is influencing the world and making companies more efficient. This trend is more than likely to continue going forward. To go back to the bias. The bias in financials versus the bias in technology. So the interesting part about technology is the rising wave of AI. So on the face of it, you would assume that that is good for technology, since there are going to be more and more organizations that try to implement machine learning and artificial intelligence into their workflow, their products, everything. So the question becomes, because, you know, recently I forget, someone said that Google and Amazon's going extinct because of AI, which is kind of funny, but like, you know, is there, the profits have to go to technology, right? The profits from AI have to go to technology sector. So it has to be an increase in the technology sector. Consumer services, healthcare, consumer goods, these are all going to implement AI solutions which are satelliting off of the technology sector. So I guess the bias is more beneficial. Yeah, I guess. When is this? This is December 2019. Let me Google an industry breakdown. of NASDAQ. Does anybody have like a graph that we just saw, like one of those? When is this? 2019. Is there like a more recent one? And this is a little bit more recent. Which was next generation? Which one? Jesus, man, you don't help out, but technology is 36% of it. Okay. Do they like say which one? Okay, so NASDAQ's 56%. Jesus Christ. Okay, we can write that down. I think we should write that down. 11 bullets. The NASDAQ 100 is much more biased towards the technology sector in comparison to the S&P 500. This has led to greater returns within the past decade. Oops. In the past decade, and the rising wave of the AI, what's it called, industrial, the AI revolution, possibly make NASDAQ, possibly continue NASDAQ's favorability over S&P 500 for this coming decade. Okay. Delete these. I still do not know. Okay, I'm just gonna try to. I had a how to. God, I do not have a clue what that was. Okay, I'm gonna try to dig it out. Okay, it was how to evaluate your 401k. Wow, and it's not even like a thing. Okay, here, let's put this speed dial in here so we can just stay organized. Okay. So then we put a track fund. Tax deferred. Then we had what are index funds. We had mutual funds. We had exchange traded. Exchange traded funds. And we had what are financial. I think that's financial securities. Yeah. Okay. We had what is a call option? Wait, hold on. Let me check out my computer because my computer's a little laggy right now. Okay, I'm definitely using a decent amount of my my RAM right now. Actually, I'm using a decent amount of everything. Jesus, man. Really, dude. Huh. Okay, it's just okay. It's fine. It's fine. So then we had what is a call option? We had equity for shareholders. We had the FT Wilshire. Then I had the bond market up. Then I had oh man, these are a lot of tabs, dude. I had what are bonds? I'm not going to sleep until I literally steam plow through all of these. And I had fixed income securities. Then I had benchmark up. Then I closed benchmark. Then I had reconstitution up. Then I had market capitalization up. Then I had outstanding shares up. I'm closing all of these tabs tonight. I don't care. Okay, then I close outstanding shares. Close. Which makes sense. And I have liquidity up. So close liquidity. And then close reconstitution. I reopen Bloomberg. Okay, so this is where I was at. Okay. So tracker fund, what is it? How it works? Tracker fund is an index fund. I do have my tracker fund is an index fund that tracks a broad market index or a segment thereof. Tracker funds are also known as index funds, designed to offer investors exposure to an entire index at a low cost. These funds seek to replicate the holdings performance of a designated index constructed as ETFs or alternative investments to meet the funding's tracking objective. So tracker funds are pooled investments used to track a broad market index or a segment of one. They are also known as index funds. Index fund management is driven by tracking functions, and tracker funds seek to replicate the performance of the market index. Passively managed tracker funds can include customized indexes for market sectors, segments, and themes. Today, market innovation has resulted in the potential for customized tracker funds, which provide for more targeted investments. Customized tracking funds are relatively low cost for investors and keep overall expenses lower using an index replication strategy. Okay, how a tracker fund works. The term tracker fund has evolved from the tracking function that drives index fund management. Tracker funds seek to replicate the performance of a market index. Market innovation has significantly broadened the number of tracker funds available in the investable market. Investing in an index fund is a form of passive investing. Initially, index funds were introduced to provide investors a low-cost investment vehicle that allows for exposure to the many securities included in a market index. The primary advantage of such a strategy is the lower expense ratio on an index fund. Gotcha. expenses. Expense ratio is determined by dividing a fund's operating expenses by the average dollar value of its assets under management. Oh, dude, they just love to get me. Okay, so this I'm chilling with. Like I could just copy this and just close this. I'll take the key takeaways as well. In the calculation of AUM, some financial institutions include bank deposits, mutual funds, and cash in their calculations. Others limit it to funds under discretionary management, where the investor assigns authority to the company to trade on their behalf. Overall, AUM is only one aspect used in evaluating a company or investment. It is usually considered in conjunction with management performance and management experience. However, investors often consider higher investment inflows and higher AUM comparisons a positive inequality, and that's true. I can understand that. Total market, that person handles on behalf of investors, fluctuates daily, reflecting the flow of money in and out of a particular fund and the price performance of the assets. Funds with larger AUM tend to be more easily traded. Okay, awesome. So we can just take that. We can BU this. Manages on behalf of clients. The larger the AUM, the more liquid the fund is. Okay. So an expense ratio, which funds are used for administrative for investors, the expense ratio is deducted from the fund's gross return and paid to the fund manager. Determined by dividing a fund's operating expenses by the average dollar value of its. The expense ratio is a measure of mutual fund operating costs relative to assets. Investors pay attention to the expense ratio to determine if a fund is an appropriate investment for them after fees are considered. Expense ratios may be stated as a gross expense ratio, net expense ratio, and after reimbursement expense ratio. Passive index funds will have lower expense ratios than actively managed funds or those in less liquid asset classes. In general, funds expense ratios have been declining over the past several years.
There's a city in the heart of...
Okay, let's watch this video.
The management expense ratio of a mutual fund is the percentage of the fund's assets that must go towards paying the fees to run the fund each year. Every investor in the fund carries the burden of paying this expense. Mutual funds take work to create and maintain. A professional money manager must monitor all of the underlying assets of the fund, research new investments, and decide when to cut old investments. Among other activities, staff must be hired, office space must be leased, records must be kept, statements mailed, and taxes prepared. As with any business, these activities prompt expenses, which are directly responsible for the management expense ratio of any mutual fund. A mutual fund charges its investors for these management fees. The The management expense ratio is a number that indicates the percentage of your investment in the mutual fund that is going towards its operations. The management expense ratio is separate from sales commissions and loads. These are front and back-end charges that an investor pays to buy or sell a fund and are not an annual expense. Investors can look to expense ratios to help determine how efficiently a mutual fund is run. Generally, the lower the ratio, the better.
Okay. What the expense ratio can tell you. Operating expenses vary according to the fund or stock. However, the expenses within the fund remain relatively stable. For example, a fund with low expenses will generally continue to have low expenses. The largest component of operating expenses is the fee paid to a fund's investment manager or advisor. Other costs include record keeping, custodial services, taxes, legal expenses, and accounting, auditing, Expenses that are charged by the fund are reflected in the fund's daily net asset value and do not appear as a distinct charge to shareholders. What is a net asset value? Jeez, man. NAV. Net asset value is the net value of an investment fund's asset less its liabilities, divided by the number of shares outstanding. Most commonly used in the context of a mutual fund or an exchange-traded fund, NAV is the price at which the shares of the funds registered with U.S. Securities and the SEC are traded. Net asset value is the net value of an investment fund's assets less its liabilities divided by the number of shares outstanding. Pre-share value calculated for a mutual fund or ETF. Okay, I definitely need to see the video on this.
There's a city in the heart of South Carolina where you can recharge, reconnect, or relax.
I love experiencing the energy in Columbia. You can really tailor your Columbia experience.
A 20-second ad, dude. Understanding NAV. For companies and business entities, the difference between the assets and the liabilities is known as the net assets or the net worth of the capital of the company. The term NAV is applied to the fund valuation and pricing, which is
Net asset value, or NAV, is a term used by funds like mutual and exchange-traded funds to represent the value of their underlying assets minus liabilities and divided by outstanding shares. Funds are bundles of securities wrapped up in single investment packaging and sold in shares. Within the fund, there are lots of things going on. The manager is trading positions. There are gains and losses, taxes, and fees. It is a complicated inner core that needs NAV as a means for establishing a value. Funds may determine NAV daily, weekly, or monthly, but it is often calculated after the close of the market each trading day. The assets of the fund are determined based on its shares of various underlying positions and the closing price of those positions, plus realized gains and minus fees, losses, and other expenses. That number is then reduced to a per-share representation. Fund shares may trade in the market for more or less than their NAV. When trading for more than NAV, it's called trading at a premium. When trading for less than NAV, it's referred to as trading at a discount. NAV can help an investor determine if the fund is overvalued or undervalued by the market. Because a fund with a low NAV that is selling for a high price may be overvalued, and vice versa. It is also important to measure the economic and news events affecting some of the major underlying positions, reduced expenses, when determine if when trading for less than NAV in the market for more that number is and per share
so the assets of the fund minus the liability divided by the outstanding shares. So if the outstanding shares is smaller, so we know what outstanding shares means. refer to a company's stock currently held by all of its shareholders. So if it's small, that means trading at a discount. Because why? Oh my god, this is hurting my head.
Shares may trade in the market for more or less than their NAV. When trading for more than NAV, it's called trading at a premium. When trading called trading at a premium more or less than their NAV. Fund shares may trade in the market for more or less than their NAV.
Okay. So it's trading for less than what it gained in revenue, let's say, or trading less than what it's... Okay, I kind of got an idea. I need to read more. For companies and business entities, the difference between the assets and liabilities is known as the net assets or net worth of or the capital of the company. The term NAV is applied to the fund valuation and pricing, which is arrived at by dividing between the assets. NAV is often close to or equal to the book value per share of a business. Companies considered to have high growth prospects are traditionally valued more than NAV might suggest. Ah, okay. Okay. So the reason why it's trading at a premium is because of the concept or some sort of projection. Right. Okay, I get it. Online whiteboard. Do we have it started? So, I got it. So, this is all the money that we have on the table. And this is to the dude Bob. Bob wears a bow tie. Alright. So this is like, this is his NAV. And we have Alice over here. She has a table that is almost identical. This is her NAV. So both of their NAV are the exact same, right? But Bob's trading at a much higher. He's trading at a premium. Now, why is that? Jesus, I don't know how to do it. So he's trading at a premium because he has this huge idea of bringing AI solutions to farming. He's bringing AI solutions to farming, machine learning to farming. And right now, his assets, his revenue isn't that high, but everyone kind of sees the image and they're like, you know, that would be really cool, right? Alice is trading at a discount. She's making a bunch of money, but she's not really she's not really trading well because her nav is coming from, let's say, it is coming from, I don't know, what's the dyeing industry? She has a taxi company. She has a taxi company. This guy's AI. She's taxi. And Uber is slowly chipping away from at the nav, so the nav is decreasing slowly, but it's trading at a much lower volume because everyone sees where it's going. They can see that it's going that way, so they're already anticipating. They're already selling off. So that's why this guy's trading at a premium, that's trading at a discount. Nav sort of helps to gauge how much of a premium and how much of a discount it is. So then hypothetically, you could say, okay, this guy trading way too much of a premium. Like, I don't even understand it. Like 3 times, like, dude, it's farming for AI. It's not gonna be crazy. Or it might be like just reasonable. It depends on your discretion. That's my explanation of it. So, really cool. That's really cool. Does it explain? Wow, it doesn't even like explain. Valuation, right? Do I have anything right on mutual funds? I do not believe so. I could check that. I can't. I can't now. Mutual funds collect money from a large number of investors, then use that money to invest in securities such as stocks, bonds, and money market instruments. An open-ended fund can issue an unlimited number of shares, does not trade on exchanges, and is priced each day at the closing of the trading. Okay, this is... This is very So 401ks are open-ended, meaning they're based on NAV pricing. This allows for profitable trading opportunities for ETF traders. Gotcha. Fund investors often try to assess the performance of a mutual fund based on their NAV differentials between two dates. An investor may compare the NAV on January 1st to the NAV on December 31st and see the difference of the two values as a gauge of the fund's performance. However, changes in NAV between two dates aren't the best representation of mutual fund performance. Okay. Mutual funds commonly pay out all of their income like dividends and interest and earned to their shareholders. Additionally, mutual funds are also obligated to distribute the cumulative realized capital gains to the shareholders. As these two components, income and gains, are regularly paid out, the NAV decreases accordingly. Therefore, though a mutual fund investor earns income and returns, individual earnings are not reflected in the absolute NAV values when compared between two dates. A reliable measure of mutual fund is the annual total return. Masterworks, that's fucking great.
Fund shares may trade in the market for more or less than their NAV. When trading for more than NAV, it's called trading at a premium. When trading for less than NAV,
So it says it's trading at a premium.
it's referred to as trading at a discount or less than other expenses. That number is then reduced to a per share representation. Fund shares may trade in the market for more or less than their NAV. Or less than shares and reduced to a
Anticipating higher projections while trading lower than their NAVs means trading at a discount, anticipating lower projections. Fair. Okay, let's we could delete that, I guess. So yeah, 'cause, what is a good expense ratio? Lower. Okay, maybe I was a little high. I was gonna go in the single digits, but I was like, that's too low. An actively managed fund often differ significantly. Index funds, which are passively managed funds, typically carry very low expense ratios. Huh. So that's interesting. I'm still in the this like small. Huh. Gotcha, gotcha. Okay, I could get like a. Roger that. Okay, I think I got expense ratio. So the term tracker fund has evolved to from the tracking function that drives index fund management. So the primary advantage such as lower expense ratio of an index fund. Probably just have that up just in general. Include the, I think I'm just gonna finish this and then dip out. Sorry guys, I couldn't dude, I can't. These are so many tabs, man. I'll finish it tomorrow. Tomorrow I'll bang all these out. Include the S&P 500, Dow Jones, NASDAQ. Investors often choose traditional tracker funds because a majority of investment fund managers fail to beat broad market indexes on a consistent basis. As markets have evolved over time, investment companies have sought to meet comprehensive demands by developing new and innovative funds and indexes to satisfy. As a result, many investment companies now work with specialized index providers or create their own customized to use and passively managed funds. Much broader definition, passively managed tracker funds now include customized indexes for market segments, sectors, and themes. Tracker fund strategies have also expanded beyond traditional growth and value index strategies to include indexes screened for a wide range of characteristics and fundamentals. Customized tracker funds still seek to track a predefined market index, but they provide for much more targeted investment. Ooh. That's interesting. Is that the same size? Still seek to investors will find tracker funds available for nearly every market index in the world. One of the most popular tracker funds is the SPDR S&P 500. I don't know what year-to-date return means. The amount of profit or loss realized by an investment since the first run. I'm not messing with that, dude. I'll mess it when I need to. Okay. I think I'm gonna end it though. Yeah. I'm gonna dip out, y'all. Damn. I really didn't get to do much today. We kind of looked at some of this stuff. God, I hate this. Wait, let me finish this page though. Alternatively, because we're right here. Many companies develop their own index with specific criteria. The fidelity, for example, the fund tracks customized. The fidelity quality factor ETF seeks to replicate the holdings performance of the fidelity US quality factor index. The index utilizes screening methodologies to identify high quality, large cap, and mid cap stocks. Investors get exposure to high quality, while the funds require, as of May 31st, returned 34.2% over the last 12 months. Meanwhile, the fund Okay, I think we can close today. We got a little bit done, but I kind of liked it. Yeah, we went over expense ratio, the assets under management, net asset value. Customized tracker funds are interesting. They might be something that we should look towards, maybe a new age solution. Index funds. Right, funds, shares. Yeah, I think we're good. I'm gonna stop because I want to go to bed, but I'll be back tomorrow, I think.